You are listening to the Retirement Lifestyle Advocates radio program. I'm your host, Dennis Tubbergen. Glad you're listening in today. Hey, joining me on today's program is my special guest, Mr. Peter Schiff. Peter will be joining me in segments 2 and 3 of today's program. I'll get his forecast for gold, for stocks, for the U.S. economy, and the U.S. dollar. I had a very lively conversation with Peter. You won't want to miss it. Again, that is coming up in segments 2 and 3 of today's program. If you've not yet requested a copy of my most recent book titled Winning Strategies, I'd like to invite you to get a complimentary copy by simply visiting the website requestyourbook.com. When you visit requestyourbook.com, you'll be asked your name and an address to which we can mail the book, and we'll get it out to you absolutely free with no further obligation. I'll also include some bonus material. Again, the website is requestyourbook.com. If you have not yet created your free login to access all the complimentary resources at retirementlifestyleadvocates.com, I'd encourage you to do that. Just visit retirementlifestyleadvocates.com. You'll be asked to create a free login, and that will give you access to the podcast version of this radio program, my weekly Portfolio Watch newsletter, as well as my weekly Headline Roundup newscast. So again, that is at retirementlifestyleadvocates.com. Well, the big news this week is the Federal Reserve will be meeting the 16th and 17th of September. And you heard it here first. We're about to return to easy money policies. Last month, when the Fed had their annual customary meeting in Jackson Hole, Wyoming, the chair of the Fed, Jerome Powell, tipped his hand, indicating that interest rates could be coming. Mr. Powell said this, quote, "The shifting balance of risks may warrant adjusting our policy stance," end quote. Powell noted in his speech that rising unemployment and persistent inflation were both risks. The most recent job report, I think, will tip the Fed into doing at least a quarter-point rate cut. That's a given. A half a point this week would not surprise me. We now, for the first time in more than 4 years, have more unemployed in the United States than we have job openings. So that reached a tipping point this past week. Now, the Fed, in addition to this week's meeting, has one coming up in October, one coming up in December. And I'll go on record as saying that I think we'll probably see about a 1-point rate cut between now and the end of the year. You know, from the time the Fed started to increase interest rates in 2022, I've been of the strong opinion that the Fed would, at some point in the near future, begin to cut interest rates before ultimately re-engaging in quantitative easing or currency creation. And my opinion has not changed. The federal government will run official deficits of $2 trillion per year or more for as far as the eye can see. Deficit spending needs to be financed by the government. The U.S. government sells debt or treasuries in the form of bills, notes, and bonds to fund the deficit and also to refinance debt. Now, as I've talked about here on the program over the past year, the U.S. government has a Herculean task when it comes to refinancing debt this year. And when you look at the recent bond auctions, the writing is really on the wall. Now, the bond auctions are where the Fed, or excuse me, where the government auctions off debt. And to get right to the point, the federal government has been largely unable to sell long-term debt. The majority of the debt that's been sold has been short-term debt in the form of treasury bills. That means this debt will have to be financed again in the very near future. And there's virtually no chance when this debt has to be refinanced, along with additional deficit spending, that the United States will in any way, shape, or form be a better credit risk. Now, to make my point, during 1 week in August, the government sold $724 billion in Treasury securities. Of the $724 billion in sales, $505 billion were bills with maturities of 4 weeks to 52 weeks. That means somewhere between 4 weeks and 52 weeks, this debt will have to once again be refinanced. Now, of that 724 billion, 505 billion, just about 2 out of every $3 had maturities of 1 year or less, and only 33 billion, less than 5% of the debt sold, was in the form of 30-year bonds. What does that tell you? It tells you that there's not a long line of people or countries or entities that want to loan the U.S. government money for 30 years. That means this debt financing burden will continue to get exponentially larger, and it will become more difficult to refinance this level of debt. Now, one of the reasons that the current administration has been pushing for the Fed to cut rates is not only to reduce interest rates on mortgages, which, as I'll talk about in a second, I believe is unlikely to happen, but also on the ever-increasing U.S. government debt that requires financing. During the month of July, President Trump suggested that the Federal Reserve's benchmark interest rate should be 3 percentage points lower than it is presently. Now, obviously, reducing borrowing costs for the federal government is clearly in the best interests of the country and the taxpayers, but there is no guarantee that a Fed rate cut would make U.S. borrowing costs more affordable or would reduce the interest rate that consumers pay for mortgages and for other debt like auto loans. A perfect example of this scenario, an example that makes this very point, occurred just last year. Prior to the 2024 election, the Fed began cutting interest rates. They reduced the Fed funds rate, which is the overnight lending rate that banks pay. They reduced the Fed funds rate by 1% by the end of 2024, yet over that same time frame, the yield on the 10-year U.S. Treasury increased by about 1%, as did mortgage rates. Mortgage rates and interest rates that consumers pay on debt, on loans that they take out, tend to track the U.S. Treasury more than the U.S. Treasury rate rather than the Fed funds rate. See, the reality is simply this: market forces determine interest rates. Credit risk determines interest rates. If you're a really good credit risk, you pay a lower interest rate than someone that may be a marginal credit risk. It's these market forces that will, in my view, drive interest rates higher no matter what action the Federal Reserve might take. The U.S. government has debt officially of more than $37 trillion. That number is climbing by about $1 trillion every 100 days. That does not make the U.S. government a better credit risk. The U.S. government has a fiscal gap when considering the unfunded liabilities of Social Security, Medicare, and other programs of more than $200 trillion and climbing. That does not make the U.S. a better credit risk. See, when this end result becomes obvious, and right now there is some demand for U.S. Treasuries simply because Britain, France, and Germany are even in worse shape. There's talk of an International Monetary Fund bailout for those countries. But when the end result becomes obvious, it will be only a matter of time before another round, or likely several rounds, of quantitative easing or currency creation commences, because the Fed will be forced to become the buyer of last resort for U.S. government debt. This is a cycle that feeds on itself. When this cycle kicks back in again, as I believe it inevitably will, that will further fuel inflation and that will drive interest rates even higher. So if you're thinking that a Fed interest rate cut will make mortgages more affordable, I think time will show that that is not going to be the case. If you own U.S. Treasuries at this point, you might be wise to consider short-term maturities. You might want to buy what everyone else is buying. And since foreign central banks now own more gold than they do US dollars, we've reached a tipping point there as well. So owning some precious metals might also be advisable for many investors. I'd like to send you a copy of my Winning Strategies book along with some more information on this very topic. The information is free. The book is free. You just need to visit the website, requestyourbook.com. The website again is requestyourbook.com. Just let me know where to mail this information, and I'll be glad to do so. I'll be back after these words with my special guest, Mr. Peter Schiff. Welcome back to RLA Radio. I am your host, Dennis Tubbergen. I have the pleasure of chatting today with a gentleman you've undoubtedly heard of, Mr. Peter Schiff. He is the founder of Euro Pacific Capital. Europac.com is the website, as well as Schiff Gold. The website is schiffgold.com. Peter, it's been about a year since we spoke. It's nice to have you back on the program. Thank you for joining us.
Thanks, Dennis, for having me on again. And by the way, you are correct. I did found Euro Pacific Capital, but I no longer operate that business. My current business is Euro Pacific Asset Management, but it has the same website that Euro Pacific Capital had, europac.com. But we're basically now just a registered investment advisor instead of a broker dealer.
So you are now a fiduciary.
Yes, exactly.
I gotcha. All right. Well, thank you for correcting me. Peter, I had you on the program about 5 years ago, and you said if you are smart, a smart investor, if you aspire to be a comfortable, stress-free retirement, you need to dollar diversify. The dollar is headed down. You certainly have been right, reflected by what the price of gold has done, reflected by what the dollar index has done. What is the future for the dollar now, in your view?
Well, unfortunately, it's pretty bleak in the near term, and we'll get into that. But yeah, investing abroad certainly this year has been more profitable than it's been in recent memory. Gold stocks are up 80% so far this year. If you just look at the indexes, the GDX or the GDXJ, which just track a broad basket of gold stocks, you're up over 80% just in calendar 2025. And I think this is the beginning of a multi-year, generational bull market in precious metals mining stocks. Nobody is really talking about it. You could listen to the major financial news channels, and they won't even talk about these stocks, even though they're doing so much better than all the stocks they do talk about. And if you look at global investing, for example, we have a strategy at Euro Pacific Asset Management, which is a global dividend payer strategy. And that strategy invests in, relatively conservative, high dividend paying, low multiple international stocks outside the United States. So not, tech stocks or, the momentum type stocks, but value, Warren Buffett type stocks, except not in the United States, outside the United States. And that fund is almost up 40% year to date, about 39 and change after today. I have a mutual fund that mimics the managed account strategy, but that's about 4 times the gains of the U.S. stock market, this year, S&P 500. And I think this is really what investors are going to be seeing for many, many years, far superior returns outside the United States than within. And part of that is going to be because of the weakness of the dollar, which I think is going to accelerate as the months and years go by, and overall weakness in the U.S. economy. And unfortunately, Donald Trump is not going to turn the tides. In fact, if anything, he's adding to the problems. He is not dealing with the debt. He is making the debt bigger. And he's practicing his own brand of democratic socialism. I mean, he is micromanaging the economy through central government planning. He's picking winners and losers. He's coercing private companies into handing over part of their equity to the U.S. government. He's enacted unilaterally protectionist legislation, high tariffs. So we're moving further away from a free market capitalist economy, and that's going to be to the detriment of the United States. And we're isolating ourselves from our trading partners who have been subsidizing our economy, frankly, by providing us with goods that we don't produce and lending us money we don't save. We're driving China closer to India and Russia. In fact, we're enabling the Chinese to make greater inroads into Africa, into South America. All this is going to undermine the dollar's role in the global economy. That's why foreign central banks are divesting of dollars and divesting of treasuries. That's one of the reasons gold is almost $3,400 an ounce. If I was on your show 5 years ago, back then it was, probably, somewhere between 1,500 and 1,700, probably something like that. But it's headed a lot higher.
So, Peter, you touched on something that seems to me to be a slippery slope. I'd like to expand on it, but the fact that you have the U.S. government now taking a stake in private companies, the rare earth minerals company, and then just recently in the news again this week, isn't that a slippery slope? And where does it stop? Isn't that the definition of fascism?
Oh, yeah. I mean, it's very fascist. I mean, I hate to even talk about Trump and saying he's a fascist because, there were a lot of people on the left trying to claim he was Adolf Hitler. And, he's nothing like Adolf Hitler, but you don't have to be a Hitler to believe in fascism. Fascism is more of an economic system that is a form of socialism, right? Fascism is not the opposite of communism. It's very similar. Both fascism and communism are forms of socialism. But yes, in fascism, you have the government taking a very active role in private business. And that's exactly what Donald Trump is doing. He keeps saying, I'm making great deals for the American public, great business deals. Well, he's not there to make business deals for the public. The president is not supposed to do that. And not only is it a problem that he somehow extorted a 10% stake in Intel, but there are other companies they're talking about the defense contractors, and they're saying the government should get a piece of those companies. And it's not just about taking a part of a business, but about now the government potentially tilting the playing field to favor the businesses that it owns at the expense of the competitors that it doesn't. So it's a very dangerous thing. And even if you think Donald Trump is a good businessman, and so we want him making deals, which, making deals with taxpayer money is not like making deals with your own money. So it's very different. But even if you believe that a president should do this, well, what about the next president? What if the next president is AOC? Is she supposed to start making business deals for us? Right? you know, a cocktail waitress or whatever she used to do. I mean, it's ridiculous. And there's no criticism coming from the Republicans. I guarantee you, if Joe Biden did exactly what Trump was doing, the Republicans would be up in arms, right? They would be against it, but because Donald Trump is doing it, they're all in favor of it.
Well, I'm chatting today with Mr. Peter Schiff. He is the founder of Euro Pacific Asset Management as well as Schiff Gold. The websites are europac.com and schiffgold.com. I'd encourage you to check them out. Peter, when you talk about the economy, you suggested earlier in this segment that it's your view the U.S. economy is weak, and it seems like the economy is bifurcated. We've got the high income earners, the people with assets that seem to be doing okay, and then there's everybody else that seem to be struggling. If this continues, if Fed policy continues, doesn't that wealth gap just get exacerbated here?
Oh yeah, I mean, basically the policies of the Biden administration, by and large, are being continued under the Trump administration, just with some extra bad stuff thrown on top for good measure. But the reason that Trump got elected was because the average American was not benefiting from that fiscal and monetary regime. And so they voted for Trump to change things. And now that Trump is in office, he's perpetuating the problems that helped get him into office, which is why I'm confident that Trump is, well, he can't run for reelection, but I'm confident that Trump is going to help the Republicans lose the Congress during the midterms and lose the White House in 2028. And that's why it's also very bad to set this precedent where you entrust so much power in the president, because now the next president will use that newfound power, that unconstitutional power, to do even more harmful things to the U.S. economy. I mean, if Donald Trump can impose tariffs without Congress appointing them, what else can the president do, right? Who knows what wealth can be confiscated, under the name of making good deals for the taxpayer. Taking money from taxes, that's going to just say, well, that's a deal. We're making a good deal. These rich people have too much. These businesses have too much. I'm just cutting the taxpayer in on the action by nationalizing their businesses, right? I mean, why stop at Intel? Why not just have the president just take over 50% of every American company and say, I'm just making a business deal. It's good for the American taxpayer. They can make an argument, well, all these companies are benefiting from all the military protection that they get and the roads and our farm. So they should have to give up a return to the government, like they don't even pay taxes. Yeah, they got profit taxes, but all this is very bad precedent. But the bottom line is the deficits are exploding. Donald Trump's solution is not to cut government spending. He increased that. His solution is to take over the Federal Reserve, stack it with a bunch of cronies, and make the Federal Reserve cut interest rates and go back to quantitative easing to create massive inflation to monetize the deficits that he's creating. And so that's what's going to destroy the value of the dollar. And the president has even said that he prefers a weak dollar, even though he won't officially say we have a weak dollar policy. That's what he says. And his policies are going to weaken the dollar. And that's going to lead to massive increase in consumer prices in the United States and ultimately long-term interest rates. But in the meantime, it's destroying the returns that investors would get investing in the U.S. And driving investors abroad. And that's what I'm strongly suggesting that your audience does. Don't wait. Don't be the last one on your block to get rid of your dollars and invest internationally or buy gold. Be the first one to do it.
Well, I'm chatting to Mr. Peter Schiff. The website for Euro-Pacific Asset Management is europac.com. The website for Schiff Gold is schiffgold.com. Stay with us. I'll be back after these words and continue my conversation with Mr. Peter Schiff. I'm Dennis Tubergen. You're listening to RLA Radio. I'm chatting today with Mr. Peter Schiff. And if you're just tuning in, Peter is the founder of Euro-Pacific Asset Management. The website is europac.com, as well as Schiff Gold, the website schiffgold.com. Peter, let me just follow up on kind of where we left off in that last segment. You mentioned deficits. I mean, we've got a deficit approaching $2 trillion, and I was just floored that the Vice President of the United States had to cast the tie-breaking vote to cut $9 billion, 0.5% of the deficit. The government now is trying to refinance debt, and it seems like they can't sell anything long-term. It's all short-term. So isn't this a debt time bomb that's going to have to blow up here in the near future?
Well, absolutely. In fact, it's blowing up now. I mean, if you look at what's happening with interest on the national debt, but you said that the debt is approaching $2 trillion a year. We passed $2 trillion a year a while ago. So, we'd have to reduce the deficits to approach $2 trillion a year. I think the official deficit is over $2 trillion, but the unofficial deficit is quite a bit larger because the government only counts the authorized spending that's on budget. But there's always emergency spending every year. disaster relief, hurricanes, fires, and a lot of stuff. So the government spends every year hundreds of billions above what's been budgeted. And they never report the overage in the official budget deficit. So if they say the deficit's 2 trillion, it's more like 2.5 trillion because there's half a trillion that they're not accounting for. But when you look at the actual national debt, which is now 37.3 trillion, if you look at the rate that it goes up every year, you see the full amount that the government borrowed. And again, the national debt, the 37.3 trillion, that only is the funded debt. The larger portion of what the US government owes is not funded, it's unfunded, like obligations to Social Security, government pensions, guaranteed student loans, guaranteed mortgages, all this stuff. These are all liabilities that dwarf the 37.3 trillion, right? So the government has massive amounts of debt. That's why Trump wants the Fed to cut rates, because we have so much debt, we can't even pay the interest on the debt, let alone pay the debt back. That's why we're headed to a debt crisis, because the way they're trying to avoid a financing crisis is by creating inflation, by having the Fed buy all the bonds at artificially low rates. But that's going to create a dollar crisis. That's what's coming. And if you thought inflation was bad under Biden, wait till you see how much worse it's going to be during the Trump presidency.
So, Peter, you use the term a debt crisis is coming. Talk to our listeners out there and just tell them what does that look like and how will they be affected?
Well, I mean, a debt crisis would be a collapse in the bond market and a big spike in interest rates. And so that would cause stocks to crash, real estate to crash, banks to fail. So, that would impact a lot of people. If you have a home equity in your house, you'd probably lose that. If you got a big stock portfolio in U.S. stocks, you'll see that get clobbered. Your bank might shut down, So a lot of bad things. You might get fired. You'll lose your job because your company is having a hard time. Or if you own the business, you may be in trouble. So a lot of bad things are going to happen if we have a debt crisis. If we have a currency crisis, a lot of bad things happen. They're just a little bit different because what happens is massive inflation. And so now the cost of living skyrockets. And so that wipes out the real value of your savings. And that also, your bank doesn't fail, but all the money that you pull out of the bank doesn't buy you much, or maybe it doesn't buy you anything. So either way, whether we get a debt crisis or a currency crisis, it's not good. It's a huge, huge problem. Nothing like anything we've experienced in this country. You'd have to go to other countries and look at those examples to see something close where they've had this. But Americans haven't had anything like it, but it's coming. And, that's why I'm out there at least trying to get people to prepare for it. I've been doing this for a long time because it's been a long time in the making. We've been able to kick the can down the road for a lot longer than I thought. But it's clear to me, based on all the warning signs that we're getting now, that we're getting near the end of this road.
So, Peter, how do you see it playing out? Do we have a debt crisis? Do we have a currency crisis? And is it dependent on what the Fed does?
Well, I think we have both. And I think the currency crisis precipitates the debt crisis because I think that they'll sacrifice the currency first, but they won't realize that it will become a crisis. They won't know how out of hand. They'll say, okay, maybe we'll just get 10%, 20% inflation over a few years, but it could really get out of hand. And then if the government is forced to defend the dollar with high interest rates, then we get the debt crisis because we can't pay. We can't afford it. And so then we have to default. And so in order to save the dollar, we probably have to default on the debt, which in and of itself is a huge crisis. But there's no easy way out of it. Either we allow a massive devaluation of the dollar or we default on the debt. So none of those options are particularly good for the financial markets or for the economy. Now, personally, I prefer default. I think that's better overall for the economy and for the American public than hyperinflation, right? But unfortunately, the easier choice politically is inflation. And that's typically the choice that politicians make when they're faced with that choice.
Peter, what would you say? There are a number of pundits out there that have been recently speculating that the price of gold is going up because we have central bank accumulation at a very rapid pace. What would you say to those who are saying that's because we're likely going to see some return to a gold standard in one way, shape, or form? Would you be on board with that? Do you think that's a possibility?
Oh, we're definitely going back to a gold standard, whether it's individuals, putting themselves on a gold standard or central banks. But the one thing that's already begun is the central banks have already shown their hand here. They want to diversify their existing foreign exchange reserves that form the backing of their own currencies that have been predominantly held in US dollars and then invested in US treasuries to the benefit of the United States. They are now divesting themselves of those dollars and those treasuries, and they are buying gold. So they are moving their reserves out of fiat dollars into real gold. And they're going to use gold increasingly as the reserve for their currencies. So that's already started. That trend is in motion. It's going to continue, and it's going to gain traction, and more central banks are going to get in on the action, especially as the price of gold keeps going up. Because as the price of gold keeps going up, the dollar keeps going down in a percentage of reserves, in addition to the fact that central banks are selling dollars. But then more central banks are incentivized to get off of a sinking ship. They can see what's happening. Their dollars are constantly depreciating in terms of gold. So they're going to get rid of their dollars and buy gold. And so what does that mean for America? That means we can't finance our trade deficits. That means the dollar tanks. That means the dollars stay here. That means massive inflation for America as we have to spend our dollars at home as opposed to shipping them abroad. And it means much higher interest rates because now central banks aren't buying treasuries anymore, right? They're not buying our mortgage-backed securities anymore. And so now we have to buy them ourselves. Well, how are we going to get more domestic demand? Well, we need higher interest rates. So this is all going to be a massive financial currency crisis on an order of magnitude that far exceeds what we went through in 2008 with the financial crisis.
Peter, we've got about 2.5 minutes left in this segment. I'd love to get your take on the relatively recently passed Genius Act. Where does Peter Schiff come down on cryptos as an alternative store of value to like gold or silver?
Well, I mean, first of all, the only crypto token that's being marketed as a store of value is Bitcoin, right? The other ones are marketed for some other supposed use case. But I think it's all pretty much smoke and mirrors. It's all hype. I mean, there could be some actual value deep beneath the surface there, but it's all about just hyping up tokens so the insiders can get rich, cashing out. Wall Street is in on the action now, and so is the Trump family, and everybody is scamming the investing public on these tokens. And the whole, I think, Genius Act by and large is meant to hype up crypto, hype up Ethereum, hype up Bitcoin, so that the insiders who helped elect Donald Trump can cash out and make real money, unloading their fake money. And if you look at Bitcoin, for example, I mean, Bitcoin is up about 22% on the year, driven by all this hype and the strategic reserve. But gold's up 28%. You could have just bought gold and you'd be better off. You could have bought gold stocks. You're up 80%, way more, 4 times what you got if you bought Bitcoin. But Bitcoin is not a store of value. That's the fraud in the marketing campaign. It's just a highly speculative token that has no intrinsic value. You see, you can't be a store of value if you don't have any value. You can't store what you don't have. Bitcoin has a price, right? It has a price because there are people who want to buy it. But price is not value. You can have something worthless trade at a high price if people are dumb enough to buy it. And you can have something very valuable trading at a very low price. And in fact, that's how investors make money. I mean, that's how value investors, if they see a business or some opportunity, a piece of real estate where they think the price is a lot lower than the value, then they want to buy it, right? Alternatively, if you see an asset where the price is much higher than the underlying value, well, you'd want to sell it. Well, in Bitcoin, there is no underlying value. So 100% of the price is hype. So, a guy who wants value wouldn't touch Bitcoin. What Bitcoin has going for it is a bunch of speculators who think it's going to go up forever. And, they're willing to buy it. Now, the question is, for how long, right? When do you run out of fools? When does the bottom drop out of this pyramid scheme? I don't know the answer to that question. I just know what it is. And I know that if you're caught with Bitcoin when the music stops, you're going to lose a hell of a lot of money. So the only way to make sure you don't lose in Bitcoin is not to own Bitcoin. And I don't own it, right? I own things that have real value, that have cash flow, and my gold stocks pay me good dividends, And if I want to have a safe haven store of value, I buy physical gold because that has it, right? Real gold, or I buy silver. So, I would encourage anybody listening to this, if you bought Bitcoin thinking you were buying a store of value, you were wrong. So sell it before other people figure it out. In fact, if you go to Shift Gold, you can actually use your Bitcoin and buy gold and buy silver. We work with a company called BitPay that makes it easy to convert Bitcoin into gold and silver. And if you don't have any Bitcoin, well, great. Just go to Shift Gold and use dollars to buy your gold and silver, because you got to get rid of those too.
Well, we're going to have to leave it there. My guest today has been Mr. Peter Schiff. The website's europac.com and shiftgold.com. Peter, thank you for joining us today. Always enjoy catching up with you. Love to have you back down the road.
Thanks a lot, Dennis. I'll see you next time. Don't wait 5 years again. It's been a long time, I guess.
We will not. Thanks again for joining us, and we will be back after these words. Welcome back to RLA Radio. I'm your host, Dennis Tubergen. And thanks again to my special guest, Mr. Peter Schiff, for joining me on today's program. If you've not yet requested your copy of my most recent book, Winning Strategies, along with all the bonus information that I'll send you to help you navigate today's investing environment and retirement climate, I'd like to invite you to visit the website requestyourbook.com. Let me know your name and where to mail all this information. I'll be glad to do so at no cost and with no further obligation. Again, the website is requestyourbook.com. And if you've not yet gone to retirementlifestyleadvocates.com to create your free login, I'd encourage you to do so. That website contains the podcast version of this radio program, my weekly headline roundup newscast, as well as my weekly newsletter. Retirementlifestyleadvocates.com is where you'll find all that. It is all free. All you need to do is create a login at that website. Well, as I mentioned at the close of the first segment, de-dollarization is continuing. Around the globe, there is movement away from the U.S. dollar. This became very evident a couple of weeks ago when it was reported that for the first time since calendar year 1996, foreign central banks hold more in gold reserves than they do in U.S. dollar-denominated reserves. Gold accumulation over the past few years by world central banks, the very institutions in charge of regulating fiat currency and setting monetary policy, these institutions have been buying gold like crazy. Gold accumulation in 2024 was just 6.2 tons lower than in 2023, which was the second largest gold accumulation year by central banks in history. Only 2022 saw central banks buying more gold than in 2023. This means that over the past 3 years, global central banks have been adding gold to their reserves at what is literally a torrid pace. And the price of gold reflects that. Since 2022, gold priced in US dollars has advanced more than 85%. Over that same time frame, long-term US treasuries have declined by 42%. And despite a recent rally in U.S. government bonds, I expect that will continue. In the first segment, I talked about the fact that the Fed is likely going to cut interest rates this week. That is my forecast. And if they do, it will likely continue to fuel inflation. With football season upon us, I thought it might be especially appropriate to talk about inflation as it relates to attending an NFL game. According to a survey by Finance Buzz, the cost to attend an NFL game this year is a whopping $158 per person. That's up 40% since 2014, and the team with the biggest increase in game attendance costs from 2014 to the present belongs to the Detroit Lions with an increase of 201%. Beer prices at NFL games also a lot higher. The Washington Commanders hold the distinction of the highest beer price increase in the NFL, rising from $6.55 a beer in 2014 to $16.49 for one beer today. 7 NFL teams now charge $13 or more for a beer at the game. Historically speaking, if you've been a long-time listener to RLA Radio, you know that this inflation part of the cycle has always been followed historically by deflation. I don't expect this time will be any different. Deflation sees the price of risk assets fall. One of the risk assets that is almost always affected is real estate. And it seems we may now be at the tipping point for real estate as well. New single-family homes for sale at all stages of construction rose to 505,000 homes in July. That's the highest number since 2007. That was at the height of the financial crisis and just prior to the real estate price crash that occurred then. Compared to just 1 year ago, home inventories are up 8.1%. And compared to calendar year 2019, home inventories are up a whopping 54%. As far as homes that are selling, the median contract price dropped 5.9% year over year during the month of July. Home builders are feeling the pain, and consequently, they're pulling out all the stops to try to sell their home inventories. Home builder Lennar recently disclosed that incentive spending jumped to 13.3% of gross revenues during the second quarter of this year. At the same time as incentive spending jumped, average home sales price fell to $389,000, down 19.5% from the peak. Builder D.R. Horton is reporting similar sales numbers to Lennar. That builder's average sales price fell to $369,600 during the second quarter of the year. That's down 11.1% from the peak as well. It's my view that real estate will have some more downside moving ahead. So this cycle of inflation followed by deflation is playing out right before our eyes. And in order for you to prosper in the environment that's coming, it's my belief that you should educate yourself. And to that end, I'd invite you to visit the website, requestyourbook.com. And when you visit that website, just let me know your name and where to mail a copy of my Winning Strategies book, along with a lot of bonus information that will help you educate yourself. Again, the website, requestyourbook.com. That's all the time I have for this week, but I'll be back again next week.